welcome to the Middle East Hotel Supply Showcase. And I am delighted to introduce three of the panelists. We have Guy Wilkinson, who is the COO of PCFC Hotels. We have Kostas Virginis, who's Vice President, Lodging and Mixed Use Development, Marriott International. And we have Grant Salter, Director, Head of Travel, Hospitality and Leisure Advisory. So we've got some big hitters here. So, very, very important. If you have any questions towards the end, you've got some great people here to ask. So, just want you to remember that. So, what we're going to be talking about here today is Middle East Hotel Supply, and we're trying to unravel some of the mysteries behind what's actually happening across the Middle East. For those of you who are close to the industry, you'll have seen a lot of the performance data over the last couple of years. We have seen some quite significant declines in some of the markets. And at the same time, we're seeing huge new supply coming through. So what I want to know first of all, with the explosion of new hotel supply right across the region in the last few years, in view of the sliding average room rates across the region, is this a reason to be concerned with new supply coming in? And I want to ask Kostas this question. Sliding occupancies, big new supply, is that a concern for us?
Thank you, Philip. Yes, we have new supply. The markets in the region are becoming far more developed. In absolute numbers, we have Dubai exceeding 100,000 rooms, going towards the 150,000 mark. Big increases in Riyadh, in Jeddah, in Doha, across all key cities. But additional supply cannot be seen in isolation. So we have to look at additional supply in conjunction with additional demand generators. What we have seen as operators is that far more investors come to us now, having done a proper feasibility study with the likes of Grant, and they seem to see that the results that we'll be getting are sufficient or good from an investment point of view, and only then they proceed. Years back, that was not the case. Years back, people were taking a far more ad hoc approach to investment, less sophisticated.
Okay. And I mean, with this new supply, so we've seen this we've seen the explosion over the last few years. What about since? And let's take the timeline of the oil price and the crash in the oil price. Grant, have we seen this trajectory of new supply? Are we seeing still seeing new projects coming in to the region?
Philip, yes, we certainly are seeing a lot more stock coming into the market. The trajectory has slowed. It's a little bit softer than it has been in the past few years. As Kostas says, there's far more maturity in the way that investors are looking at decisions to develop. However, we are still extremely busy in terms of doing feasibility assessments. If one looks at the pipeline of new product coming to the market, particularly in the UAE, Saudi, Qatar is a slightly different dynamic in that it's very much a supply-led market and not a demand-led market. But certainly those three markets, there is a massive supply of stock coming on board. And there are time horizons certainly for the UAE, Dubai in particular, a lot of build up towards 2020. Certainly for Qatar, a lot of build up towards 2022. So there are very finite time horizons where there is a requirement to build a certain amount of stock. Similarly in Saudi Arabia, the opening up of that market, the liberalization of that market, and with a strong focus on domestic tourism is driving a lot of the supply for product, particularly leisure type product within the kingdom.
So we're seeing a different type of hotel. You know, the traditional Middle East. I know things are changing, but traditionally very upmarket luxury hotels. Are we seeing a change in supply over the last couple of years? Type of product?
Yeah, we are starting to see the dynamic shift a little bit away from the top end of the market, but overwhelmingly, almost 56% of the stock that sits in the pipeline, certainly for Dubai in any case, still sits within that luxury and upper upscale sector, so the 5-star sector. Whereas the lower sectors, your mid-market sectors, sit somewhere only in the region of about 30% of the stock sits within that sector. So still there is a skewing towards the luxury, the top end of the market, but it is changing. In Saudi in particular, we are starting to see more moderate stock, more mid-market type stock coming into the market. But again, still the majority still sits within that the upper end of the market.
Yeah, and certainly borne out with our data, luxury is still very, very important. Costas, you're going to make a comment.
Yes, I would like to add to what Grant was saying, that clearly we've seen a significant increase in demand for our, let's call them 4-star products, so upscale products, which is a definite shift the past 2 or 3 years. Clearly, the upper upscale segment has a good representation, but also what we see is that we're moving away of the traditional cities. So it's not just Dubai anymore, it's also Ras Al Khaimah. It's not just Riyadh anymore, it's also Abha Tabuk. It's secondary locations that cannot sustain an upper upscale product, and the only option is an upscale product.
Okay, and Guy, you are heading up a relatively new hotel company, and I think the segment that you are looking at is smart budget hotels. What do you see in that kind of arena? What are the opportunities, and where are you looking?
Yeah, it's a new enough chain for us not to have actually any hotels yet, so that new. We're building a hotel and we're building a brand at the same time. 3 stars, we're looking at an average rate in Dubai around about 300 dirhams. As you say, smart, and if I could tell you any more about that, I'd have to shoot you. So when it opens, it's going to be the smartest. But you know, in answer of your original question, you know, how do you look at a market that's growing, especially one like Dubai? And I think our case as a developer is quite typical of other developers. We look at our first location is in International City. There were no hotels there until the Ibis Styles opened last year or the year before. There's a Premier Inn that's under construction, and so those 2 hotels will be up and running by the time we open. And we say, okay, is it a good idea for us to do our hotel? We look at the occupancy, the figures that you showed us, 90% occupancy, 100,000 rooms in Dubai, this up to the end of April. Dubai with the 2nd highest average room rate in the Middle East, is that right? After Mauritius and somewhere?
I would almost say, well, it's for end of March,
Yeah.
Dubai had the highest average room rate.
Right.
Yeah, I mean, Jeddah's always been competing, but Jeddah's dropped a little bit, but the highest for sure. In fact, globally, very, very close. Hong Kong, Sydney, I think, are the 3 cities with the highest occupancies.
Okay, so we comfort ourselves with little details like that. And we say, okay, the International City where we're opening is probably the size of Al Barsha in land area. How many hotels are there in Al Barsha? 80, 90? And there's 2 that's open in front of us. I think we can probably deal with that, and we're pretty confident that our brand will have something extra that will appeal to a different kind of guest, or take their guests and get them to stay at our hotel. So that's the way we look at it.
I often hear that one reason why mid-market hotels don't get huge traction in the Middle East is price of land. But what I find rather odd about that is you're not going to build a mid-market hotel on the beach, but you might shoehorn it between two buildings in Barsha. I mean, is it still cost prohibitive to build a mid-market hotel on that basis?
I'll start the conversation, and the rest of the gentlemen can carry on. The physical layout of Dubai, essentially in a long straight stripe, typically is part of the problem. So the further you go away from the main centers, the less appealing and the less connected the city is in terms of transportation. And people that are typically traveling on a budget want to be as close to public transportation and those kind of access facilities as possible. In this, the way that Dubai is laid out, if you are starting to push into, let's say, Dubai land, which is not cheap in terms of land, but cheaper, less expensive than some of the more premium areas, you have the issue of being so distant from everything else that it makes it more challenging to drive volume into that particular property. So that the price of land certainly, there's no question about demand. There's no question about being able to develop hotels with high occupancies, strong GOPs. But the minute you throw in the price of land, it makes the model fall over or very close to the edge, as we were talking about earlier.
When you say, and I just want to try and understand this, when you say land is not cheap, I mean, in my rather naive way, I just look into the desert and think, well, there's an awful lot of space out there. But how does it compare with some of the other major cities? I mean, is it comparable in terms of price? Or?
It's substantially higher. It's a good 20.
Substantially higher.
Yeah, the general price of land in Dubai, in comparison, you can't compare London. You can't, because it's just not a comparable market. But the price of land here, in comparison to most of the other up-and-coming destinations, is substantially higher. Even when you push into the more remote areas of the city.
But if I may, Philip, I think the formula that we use in the middle of the market, or in the economy stratum, as I would call it, is the whole Inn Express adage, which is you should be in secondary locations in primary destinations, or primary locations in secondary destinations. Obviously, it's an oversimplification, but it refers to the land cost. I mean, the land cost and the build cost. Obviously, the build cost for a 3-star hotel has to be cheaper. You peel away facilities. You don't have a ballroom. You don't have a spa. These kind of things you can do without. So your build cost is cheaper. Your land cost should be, theoretically, in sync with that, and your operational costs, obviously. In fact, I think as you get closer to the economy or budget end of the market, the more difficult it is to balance the development books. You have to be really strict on all of those things. Otherwise, you just can't make money.
Okay.
And if I may, land is one thing. The second thing is the actual product. So quite often we see people coming to us and they want a 4-star product. And they really want to build a 5-star product. So if we're talking about a 4 Points by Sheraton or a Courtyard by Marriott, if you start adding a ballroom, secondary restaurants, etc., A, you need more land, B, the total development cost escalates, and this really messes up the whole economy, mid-market, financial equation.
I want to turn our attention to Saudi Arabia, which has some of the largest pipeline in the region. If we look at Riyadh, for example, Riyadh is due to double its hotel supply. Jeddah, which is a market which has had relatively new supply over the last few years, certainly things are changing there. And we do see some challenging data coming out of Saudi Arabia. Are there still opportunities? Are there concerns in Saudi Arabia? Or is this just a simple blip? And are there still opportunities in Saudi Arabia for new hotels, and what type of hotels?
If I may take this one, Saudi is a very large country, so it's very hard to generalize. We clearly have the two holy cities of Mecca and Medina, and the potential there is possibly unlimited.
In Medina?
Mecca and Medina,
Mecca,
yes.
Medina.
The amount of infrastructure work happening, expanding the mosque, the train to Jeddah, the new airport in Jeddah that is clearly creating the infrastructure so the city can accommodate far more demand. And we know that the demand is there. So that is one market. The three commercial cities, Riyadh, Jeddah, Ahobor, again, completely different dynamics, and they are in a different part of the cycle. Riyadh is far more advanced, Jeddah is not, and therefore the potential in Jeddah is significant. Also, just to put things into perspective, proportionately the market increases, or the supply increases in Saudi are large, but in absolute numbers, we're still talking about 5, 6, 7,000 rooms, as opposed to Dubai, where we have a pipeline of 50,000 rooms, or something like that, right? So it's a much smaller scale.
Unless you're talking about Mecca, of course. You know, my friend Abdullah is building the Ma'ad Hotel with 11,000 rooms,
Sure.
which has now beaten the Abraj Kadai with 10,000 rooms. You know, and one understands that the demand for pilgrimage to the holy cities is basically a tap that they can open whenever there's more hotel rooms. There's frustrated demand there.
How would
Yes,
they,
it is.
How would they operate a hotel of that size? Would they give it to an operator or would it become a sort of a several hotels within a complex? Marriott involved at all?
So typically, large hotels like that are so demand in Mecca is seasonal, right? As you know from your data, you have 2 months with very, very high occupancy, 2 months with very, very low occupancy, and the remaining of the year, it really depends where you are within the city. It's not dissimilar really to the concept of a seasonal hotel in the Swiss Alps, the Greek islands, somewhere else. You have 2 or 3 months that you will make probably 70% of your revenues for the entire year.
What about Marriott in terms of moving forward in terms of new type of properties? Is Marriott got not necessarily new brands, but any innovation, different types of properties coming through in this region?
So for the time being, obviously we're very happy to integrate the Starwood brands into our system. Huge opportunity from a loyalty program point of view. When it comes to brands, it's not about bringing new brands to the region. It's more about looking at different markets, identifying the relevant demand generators, and then seeing where we should plant more flags should the opportunity arises. On the hotel side, on the residential side, we are developing our branded residences product, primarily in the luxury market. And we are in discussions with several potential developers for Ritz-Carlton branded residences or products like that.
I want to come back to Dubai now. I mean, Dubai has an astonishing story of both supply and demand. I know we mentioned a couple of numbers. In 2007, there were 38,000 rooms in Dubai. And as you said, there was over 100,000 now. We got 22,000 rooms in construction, 23,000 in the planning stages, all hoping to open by 2020, so possibly 150,000. Is this feasible, Grant? Is it realistic? Or, you know, we talk about attrition, and it's very, very difficult to really understand the attrition of these properties, but do you think it's achievable, these sort of numbers?
I think that remains to be seen. But if one looks at history, can you remember the occupancy when we were at 38,000 rooms?
Well, I remember back in 2008, the highest average room rate in Dubai was March, I think, at $385, and similar sort of occupancies, 85, 86%. And interestingly, in the luxury sector, $601 was the highest average room rate in 2008.
Yeah. So if somebody had asked you the question you've just asked me in 2008, what would your answer have been?
You're
It would have
crazy.
been, yeah, exactly. And here we sit, almost triple the amount of the supply. Occupancy is still hitting close on 80%. ADRs, yes, they've come down to on the $200 mark, give or take. So what is the reason why we couldn't push significantly higher at similar types of rates and occupancies? If one looks at the market dynamics, a market that is running, or a hotel that is running, let's take it on an individual hotel basis. A hotel that is running at 80 to 85% occupancy is not efficient. At times you are going to be running very close to or at 100% in order to achieve that 85-ish% occupancy. There are going to be times when you're lower than that, given the seasonality of the market. And the same applies across the entire market. So there are going to be times now, as we've seen in the last couple of weeks, when the occupancy is running into the 90s. That tells me that there is sufficient demand to absorb a significant growth in supply. Understanding, again, as Costa mentioned earlier, that the infrastructure development around the city of Dubai in particular has matured significantly over the last couple of years. We've seen the various theme parks that have opened. We've seen the canal and all the activities around the canal. We've seen the airlift improve significantly. All the additional features that make Dubai the attraction that it is today just keep expanding and expanding and getting better and better. So is there a concern that there will be a slide in performance after 2020? Yes, there has to be. Logic tells you, simple mathematics, that there will be a slide in the occupancy, more so in the rates. But let's not forget that we are sitting at one of the highest rates of ADRs in the market on the planet, as we were talking about a little earlier. Is that justified, given the product, given the destination? I'm not going to answer that, but there is room to move within that rate profile that allows us to flex and drive that occupancy higher and maintain the occupancy as we go forward beyond 2020.
Okay.
And if I may add, we cannot look at this in isolation. If you look at all the GCC countries, not only Dubai, not only the UAE, all GCC countries have put tourism very, very high in their agenda as a very, very important pillar of their economies. Why? Because it attracts investment, jobs, you name it. So the hotel industry is only one of the pillars of the tourism industry. They're managing the rest. They're managing the airlift, they're managing the infrastructure, and clearly what we've seen in Dubai, what we've seen in Doha, what we've seen in Abu Dhabi and Saudi, the governments are doing what needs to be done in order to support that additional supply. And importantly, the local investors believe in this vision and they're willing to invest their money into this.
I think also, if I can add, that these cities are expanding, not just with new tourism product, but with new districts. And if you think of Al Basha in 2005, when the Mall of the Emirates opened, there was nothing there before that. And now it's a full hotel sector, and there will be more and more of those as Dubai, for example, goes towards Dubai World Central. There's a new hotel market growing there as we speak.
I always wonder about the business mix. I mean, the big business mix, particularly when you look in Dubai, is very difficult to actually nail it down, but maybe 70% leisure. And as we sort of move to these sort of big numbers of 150,000, surely the business mix has to change. If you look at London or New York, you've got a big level of corporate business, the foundation, and then leisure comes on top. I mean, again, is this, with 150,000 rooms, can it still sort of maintain a 70% leisure kind of leisure business?
Why are we using London as a benchmark and not Orlando?
I just simply, yeah, I mean that's a fair comment.
You know, if one looks at the mix of the market now, and again, using my analogy a little earlier, the mix in 2007, 2008 was very much the same as it is now. In fact, it's probably grown quite significantly in terms of the leisure component. So I don't see necessarily that being a challenge or a concern. Clearly, the business and the corporate sector will need to grow, and I believe it is growing. But Dubai will be a leisure destination. That's what it sells.
And also the tourist segment obviously has an impact on the length of stay. And you add another day onto the stay, and you increase your total arrivals exponentially.
I just want to ask another question. I think I'm going to play this safe and ask Grant. But with you know, with the declines, and actually the first quarter of 2017, we think things are beginning to stabilise a little bit. But I'm curious about the owners. You know, are the owners quite philosophical about what's happening in the marketplace, or you know, are they applying a lot of pressure, do you think, on the operators? I'm not going to ask Costas, but I'm just curious if Grant, if you have any insight into that.
Throw me under the bus here, Philip. Look, the owners typically remember the good times, and only remember the good times, and always benchmark on the good times. And unfortunately, we haven't. We've had two very strong spells of performance. We had the 2006 and 7 period, and early 2008, and then we had 2012 through to 2014. Very, very strong periods of performance. And owners tend to remember those more than anything else. To answer your question, yes, there is pressure being put on the operating body, largely speaking. We are getting a lot of inquiries about performance optimization and asset management and owners representation and all those kind of services that we provide for us to advise owners and help them understand how performance should be, and not what it was, but how it should be. We had a very interesting one, no names mentioned, but a client came to us late last year and said, I suspect there's fraud going on in my hotel. And I said, okay, what sort of evidence do you have? Well, no, the performance is significantly lower than it was 2 years ago. I said, well, okay, do you understand that the market has dropped significantly in terms of ADR in particular? Oh, no, I hadn't realized that. So, you know, there is an element of naivety within the ownership body, broadly speaking, and that's not being disrespectful in any way. A lot of owners are purely invested in hotels because it's another real estate class. But there is certainly pressure on the operating and the operators to tweak things and get the performance levels up to a level which is comparable to where it was in the past.
And I guess we must remember that you know, I also get wheeled in now and again to owners' meetings, and I try to talk about the trends of the market, and then I get thrown out rather quickly. No, I'm not listening to that sort of information. But the average room rates across the region are considerably higher than any other region. I mean, do we think that the Middle East will always maintain this premium, or do we think at some point it might kind of come more in line with some of the
I think we need to be careful of putting everything into one bucket and saying the region, because the room rates in Qatar, for example, and Saudi to a less extent, are quite significantly lower than they are in Dubai. Is there a rationalization that is needed in the market? Clearly, from the owner's point of view, that they would say no, we want to protect room rate as much as possible. From the authorities' point of view, and there's always this mismatch between the requirements of the tourism authorities or the government from one perspective in terms of driving tourism volume, and the owners who are trying to drive bottom line. clearly from the authorities' point of view, the lower the room rate, the more demand they're able to generate. It's a better value proposition for the destination. So I think given the massive increase in supply that you are starting to see, those room rates will start to slide further and slide from a point of view of rates that were set at the highs of 2014. Yes, we're off those numbers, quite significantly off those numbers, but the question is, were those numbers realistic to start with?
No, absolutely. And I think, I remember looking at the 2014 data and thinking, all this new supply, can we still maintain those sort of average room rates? Okay, we are not too far from the end of the session. And does anybody have any questions about supply, demand, growth within the region?
Hi. We have listened very interesting updates on definitely on room inventory. Some large properties coming up on board up to 11,000 rooms. I was just wondering whether Dubai is ready for smaller scale properties, 30 to 50 rooms, boutique properties on the upscale, driving 300, 400 US, more on design oriented properties.
More of the design types. So you're asking if smaller properties, 30 to 50 rooms, design style of, okay, Costas, have you got a view, or Guy, have you got a view?
So it is a feasibility question. Financially, with the current model that operates in the Middle East, it doesn't work. You need the only places that such hotels work are in Europe or the US or somewhere else where you have owner operators with a management agreement style. It doesn't make any commercial sense for the owner. So they're forced to develop large projects to accommodate the land prices and the nature of the demand.
Guy, you've been looking at this.
If I can add for Jose Luis, the boutique hotels that have come up in Dubai are all big brands, basically, from the big chains. Bulgari from Marriott and Andaz coming up from Hyatt, etc., etc. They're all they're not owner operated. There's no man behind the reception desk with the passion for the design. It's come from the head office somewhere. This is Dubai for the moment, but inshallah in the future, maybe you'll set one up.
From our side, we've done a number of studies on that market, on the true boutique market, the 30, 40, 50, 60 key market. In order to make the financials stand up and generate what we would call investment grade returns, it's extremely difficult to do. The price of land, again, if you are building a 30, 40 key property, you could, by virtue of going higher, be building 200 keys. The economics of it don't work when you factor in the price of land. It just doesn't work.
What about existing buildings, renovation, or is there an opportunity there, or is it just pointless?
I was just going to point out that there is the Al Maha Resort, and the average rate there is what, $3,000 a night, I think.
Yeah.
So
that's in the middle of the desert. Though,
that would do. That would do.
Not exactly a typical hotel, is it?
Okay, I think we got one more question there.
I guess just following on from that, we're talking about the feasibilities of the properties, but the Middle East market is very different. The price of land is really dependent on when you build upon it, and quite often the land is granted. And you see a lot of new products coming to market, like Grove, for example, where you've got joint ventures, and joint ventures, some parties bringing the land, and the other parties bringing the money and developing it. So the feasibility, normal feasibility study sits on its head when land is given. It's free. You can just develop it. It's surely a good investment proposition, isn't it?
Grand.
If the land is in fact granted and has no particular value in valuation terms taken into account, then certainly that model is easy to make work. which is why Rove and Emaar Hospitality are able to develop Rove at the scale and the rate that they've been doing. And it's a brilliant product. It works exceptionally well. If that same product were to be developed by, let's say, a private developer who would need to account for the land, it wouldn't happen. But you're quite right in saying that there are some interesting structures coming up trying to take advantage of the gap in the market for mid-market product. As I've said earlier, there is significant demand in that market. It's trying to arrive at a structure that works for the landowner if the landowner is not the investor or the developer, and the operator and the developer, trying to get all three parties to generate a product and a structure that works for everybody concerned. And we've seen one or two. We are working on a few products at the moment that have potential to see the light of day, given some flexibility in the structures. Historically, as you've said, granted land has been developed into similar type of properties, but the minute you try and develop on that land and transact to a third party, there's a component of value that needs to be taken into account by the funder or by the developer, and that's when things starts to get a little bit messy. But there is some light at the end of the tunnel. As I say, landowners are starting to see that the opportunities are there if they're just a little bit flexible.
Yeah, and we see this a lot with leased land. This is becoming very common in Saudi Arabia because, as you may know, they've introduced a new land tax for undeveloped lands. So landowners do not want to sell the land. Developers don't want to buy the land because that's a very big upfront expense. A happy medium is to lease the land on a long-term basis. Instead of an upfront capital expenditure, it becomes an annual expenditure, and it's a far better model.
Hi. I believe Kuwait has not been mentioned much, and it's not comparable to Dubai and Saudi Arabia business. However, I would like to hear your feedback on the current situation, because there is around 10,000 rooms available per day, and there is like 47 properties between 5, 4, and 3 stars, and their occupancy average is 60% on a monthly basis. So I'd like to see what's your visibility on the Kuwait market in the hotel industry.
Grant, have you worked on Kuwait?
Well, yeah, I think that my answer would be a fairly straightforward one. We do very little work in Kuwait, and that's probably indicative of the level of opportunity that there is in Kuwait. From a market point of view, there isn't significant growth in the demand side of that market, which then makes the growth of the market somewhat challenging. The last project we did in Kuwait was probably 3 years ago. There just hasn't been the swell of development activity required in Kuwait of late.
But however, they are still opening new properties. The supply is still growing, and you're saying demand is the same.
Well, demand is fairly stable at, the occupancy rather, is fairly stable at, as you say, somewhere around about 60 to 65%. Room rates are again fairly stable. They've come off again, as everybody has in the last couple of months, the last couple of years, I beg your pardon. So demand is there, but is there significant enough demand to trigger meaningful growth in supply, significant growth in supply? And it would seem not. It would seem not.
We have time for a last question. Does anyone have any questions?
Okay, we're good. Well, I would like to thank the panel, Guy Wilkinson, Kostas Virginis, and Grant Salter, for taking time out of your day. Thank you very much for attending.